Price action does not predict. It tells a story. Price is the result of a process. Volume is the energy required to produce that result. Every candle is evidence of what actually happened. A struggle between buyers and sellers. Pressure, absorption, and fatigue. A sequence of candles is not a pattern. It is a record of a system moving between equilibrium and disruption. Pure technical analysis does not begin with indicators. And it does not rely on setups. It begins with reading the process itself. Like an archaeologist who does not guess history but reconstructs it from layers. The technical analyst reads price footprints to understand which forces were active and where the system was accepted or rejected. In this video, we read price action through three complementary structures. The first is the understanding of ranges, attractors, and bifurcation. How a market exits equilibrium, and how it tests whether a new state can be sustained. The second is reading candles through volume, not colors or formations, but energy efficiency, absorption, and exhaustion. The third is time as structure, using Fibonacci applied to the session itself, not to price, to identify the stages of accumulation, synchronization, and dispersion. Within a closed market system, the goal is not to predict what will happen, but to understand what has already happened. Because once the process is clear, the most probable continuation is no longer random. Candle 1, the probe. Here we see a moderate rise in volume, a medium-sized body, and no upper wick. What this tells us is that the system is beginning to step out of equilibrium after a prior consolidation. There is enough fuel to move price, and the absence of an upper wick shows that resistance is still limited. In practical terms, this candle sends a very clear signal. Buyers are starting to apply pressure, and at this point, there is no meaningful counterforce pushing back. Candle 2, the true break, pure flow. Volume expands above average, the candle body grows, and wicks are almost completely absent. This is what a laminar state looks like. Effort is being translated almost perfectly into result. Volume turns directly into price movement, with minimal friction. Mechanically, the engine is operating at peak efficiency. At this stage, the analyst identifies a positive bifurcation. The system has clearly and decisively shifted from one state to another. Candle 3, the stalled candle. Volume suddenly spikes to roughly 150% above average, even higher than Candle 2, yet the candle body contracts sharply and is surrounded by both upper and lower wicks. This is known as an equilibrium candle. The body is tight, compressed, and positioned right in the middle of the range. What this actually means is that the system has entered a conflict zone. Effort remains extremely high, but the outcome collapses. Buyers are still pushing, but sellers have begun absorbing orders. Internal tension inside the system rises rapidly, and congestion replaces flow. Candle 4, the illusory surge, exhaustion and blockage. Price suddenly expands with a very large bullish candle that closes near its high, showing almost no upper wick. However, despite the strong visual expansion, volume fails to exceed the peak seen on Candle 3. This is the deceptive part. On the surface, it looks like strength, but structurally it is an all-in move by buyers. The fact that volume does not surpass Candle 3 is critical. It confirms that the sell orders sitting at the prior resistance were neither absorbed nor exhausted. This creates what can be described as the concrete wall effect. Closing at the very top without an upper wick, in this context, is not dominance, it is impact. Buyers used their remaining momentum to reach a level where they were instantly stopped by a superior and unyielding supply force that they simply lacked the energy to break through. Although the candle appears powerful, when it occurs after an extended advance and extreme effort, it represents an energy climax. The system is overheating. Candle 5, the law of absorption, key candle. Volume remains very high, nearly matching Candle 4, but the candle flips bearish and closes with a long upper wick. This is the moment where the trend breaks internally. A massive amount of effort is deployed, yet price is aggressively pushed back down. From a mechanical standpoint, this confirms that sellers are dominant at this level. They absorb the remaining buy orders and then overwhelm the market with supply. Buyer effort is fully converted into seller result. This candle marks a structural reversal point. Candle 6, dissipation. Volume drops sharply, and the candle becomes small and bearish. What this reflects is pure energy decay. After the explosive effort seen in candles 4 and 5, buyers are exhausted. The market loses lift and begins to move lower under inertia alone, without the need for aggressive selling. Candle 7, the last gasp. Volume is extremely low, and price attempts a minor upward move with a small candle. This is not strength, it is desperation. The remaining buyers make one final attempt to lift price, but the lack of volume exposes the reality. No smart money is involved. This is a classic bull trap. Candle 8, collapse to the attractor, reversion. Volume rises again, this time accompanying a long bearish candle with a lower wick. Here the system finally capitulates. The market accepts that the upward bifurcation has failed. Energy is now fully redirected downward as price returns to its original equilibrium zone, the attractor that existed before Candle 1. Analysts' conclusion for the chapter. To understand any constellation, the focus should never be on candle color, only on efficiency. When volume is high and the body is large, as in Candle 2, continuation is likely. When volume is high but the body is small or dominated by wicks, as in Candle 5, reversal through absorption is at work. When both volume and body shrink, as in Candle 7, the move is already over. The story of this chart is straightforward. A breakout attempt that ran into a concrete wall at Candle 5, followed by collapse driven by energy exhaustion. The geometry of rupture, the mechanics of the range retest. When we observe a chart without volume data, we shift our analysis toward the law of range conservation. In a chaotic system, price perpetually seeks an attractor, an equilibrium range. The moment this balance is disrupted, the system must undergo an acceptance test before adopting a new state. 1. The attractor as a probabilistic space, the range. The gray boxes on the chart represent the attractors. Observe the dashed red line. It is not merely a line, it is the threshold of the system. The dynamics. The price moves within the range, repeatedly drawn back to the 0.5 midpoint, the center of equilibrium. This represents a state of inertia. The market feels comfortable within these boundaries. 2. The bifurcation event, the red arrow. The red arrow marks the bifurcation event, the rupture of the structure. The mechanics. The price exits the gray equilibrium range. In ATTA terms, this is the first time the system declares, "I no longer belong to this attractor." The significance. Breaking below the range's support line is a deviation from the norm. However, a break alone is not proof of a permanent change. It is merely a statement of intent. 3. The range retest, the return to equilibrium test. Following the rupture at the red arrow, the price performs an upward movement, labeled as the range retest. The mechanics. This is the re-evaluation. The system tests whether the force that broke the structure is authentic or if it was merely temporary noise that will revert to the old balance. The mechanical story. Notice how the price returns exactly to the dashed red line, the lower boundary of the previous range. It fails to close above it. The interpretation. The boundary that previously served as the floor, support, has now become the ceiling, resistance. In physics, this is a state where the system is rejected by its previous configuration. 4. The shift confirmation. Once the retest fails and the price begins to leak downward from the red line, the outcome, the old attractor, the upper box, is officially dead. The analyst's insight, all buy orders previously held within that range now become dead weight, overhead supply. The system shifts its focus from seeking value at the upper 0.5 midpoint to seeking it at the 0.5 midpoint of the next range below. Chapter summary. How the analyst interprets this dynamics. Instead of searching for specific candlestick patterns, the analyst looks for transitions. Identifying the home range define the boundaries of the attractor and the center of equilibrium, 0.5. Identifying the deviation, break recognizing the moment price exits the home, the red arrow. Verifying the rejection, retest waiting for the test of the old boundary. If the price is rejected by that boundary, the bifurcation is confirmed. Continuity. Entering the trade is based on the realization that the system can no longer return to its previous home and must, therefore, find a new, lower equilibrium. This chart is Euro to US dollar on a 15-minute time frame. And the Fibonacci you see is not drawn on price. It is drawn on time. The Fibonacci is stretched from the opening of the session to the closing of the session. This transforms it from a technical tool into a map of a process. Each Fibonacci ratio represents a state of the system, not a price level. A trading session is a closed dynamic system. It has a beginning, a development phase, and a decay phase. Time in markets is not linear. It accumulates information, constraints, and energy. From 0 to 0.236, the market is in an accumulation state. This is where overnight orders and information are absorbed. Price may move, but the movement is inefficient. This is noise, not direction. From 0.236 to 0.382, the system begins to lose degrees of freedom. Failed moves appear. Options are being eliminated. The market is not choosing a direction yet. It is defining its constraints. Between 0.382 and 0.618, synchronization occurs. This is where real movement develops. Volume becomes efficient. Candles begin to align. Mechanically, the system has found the path of least resistance. Statistically, this is where the session's true behavior emerges. After 0.618, energy dissipates. The process is no longer being built. It is being distributed. The market either slows, ranges, or searches for a new equilibrium. This behavior is not random, but it is not deterministic. It is chaotic. The Fibonacci does not predict what will happen. It defines when the system is structurally capable of producing a meaningful outcome. This is not price action as patterns. This is price action as a physical process. And the chart is simply the footprint of that process.